Evolution Gaming, ticker symbol EVO, is crashing in the after hours, and we're going to talk about why people are freaking out. The stock is down 18%. No, God! No, God, please, no! 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 And it is a very, very ugly day for Evolution shareholders, including myself. I am an Evolution shareholder. This stock is about 8%, probably now 7% of my portfolio. So a sizable position, down significantly. It does hurt when you get the thesis wrong, but we are going to ask the question, is the thesis broken? Did I get it wrong, or is this just short-term noise? That is what we're going to ask and answer today. But before we dive in, if you could please go ahead, like and subscribe. It really, really helps the channel, like mine out. Let's dive in. And you can see why Evolution is down 20%. Because they missed on revenue expectations, missed on EPS expectations. The company was supposed to report 543 million euro. They actually reported 520 million, 3.9% growth on a year-over-year basis, 6.1% on an FX neutral basis. They missed revenue by a lot, by about 20 million. Revenue growth was supposed to come in at about 8.5%, 9%. So they missed by about half what the market was expecting. EPS came in at $1.24. Euro 24. Analysts were expecting a Euro 37. It's actually a 2.3% decline on a year-over-year basis from the same period last year. Management don't really give guidance. They just give a margin guidance for EBITDA. And they reiterated the 66 to 68% margin guidance and capex of 140 million, which would be about 15% year-over-year growth, showing that management continues to invest in growth for the longer term, especially international expansion. Looking at the margin profile, everything was very, very mixed. Now, we do know that Evolution has 100% gross margins. A very, very attractive thing about this stock is that it doesn't incur any cost of goods sold. And it's why the margins are so high for this business. EBITDA margin actually fell over the same time last year, but still hitting 65.6%. Free cash flow margin actually increased significantly. We're going to talk about why. You can see a free cash flow came in at 361 million versus 282 million from the same time last year. That is a 29% increase in free cash flow. So regardless of what we saw here in net income, where we saw a 5% decline in net income, we actually saw a huge boost in free cash flow. And again, we're going to talk about why a little later on. The company's balance sheet is pristine. They have $969 million in cash, $92 million in debt, virtually zero debt at all. And like this number right here, this red box should really be about like this size right here, even smaller. It's just to fit the font in. That is why it looks about half the size of this cash box. But the balance sheet is great. Free cash flow is great. Free cash flow margins are good. Gross margins are good. It was really just here when it came into the operating expenses of the business. That is where a lot of the pain was felt in the business. I think mostly had to do with revenue. You see, revenue actually only increased 4%, but operating expenditure increased 14.8%. And this was due to expenses across the board. Personnel expenses increased again because the company is expanding for growth internationally, building more studios, making more games. With growth comes costs, and depreciation and amortization plus impairments also saw an increase on a year-over-year basis. Same with operating expenses. And that is how operating expenses overall increased just shy of 15%. And when you have minimal revenue growth and operating expenses increasing more than revenue, you're going to get to a point where profit, net income actually declines negative 5.4%. Now, we have to talk about why this was the case. Why did revenue not meet expectations? And why did we incur higher than expected operating expenses? And the CEO breaks it down here in his CEO note. I'm just going to read it word for word for you guys. He says, the decelerated growth rate in the quarter is not only impacted by the development of currency rates, so they did see some currency exchange headwinds, but also connected to the conscious actions we have taken that will be beneficial for the business in the longer term. Firstly, we are addressing the ongoing issues in Asia, where we are implementing technical countermeasures to stop the criminal cyber activity, which has put pressure on revenue growth. Secondly, and on top of what we have already done in the UK, regulatory requirements, we have taken proactive and self-initiated actions in February to ring-fence additional regulated markets in Europe. The effects have varied, with the largest negative revenue impact in markets where channelization is low. we have had constructive dialogues with all of the large European regulators of the quarter and continue to support them in ways that we can. So the first issue right here is Asia. It continues to be a headwind because it's not contributing to growth. It's why we're seeing revenue stagnate ever so slightly, but this should make for good comp in the year ahead. Secondly, because of what happened in the UK and the UK Gambling Commission, Evolution Gaming has said, you know what, we're going to self-regulate ourselves just to ensure what happened in the UK doesn't happen in all of these other countries like France, Malta, etc. Now, I'm not going to go in what actually happened in the UKGC, but there was regulatory fines that could occur, as well as potentially Evolution losing their license just because of some of the gray market activities that was going on right there. You guys can go ahead and read about it. So they said, look, we're going to take actions to go ahead and ring fence that ourselves. And that is going to ensure sustainability in the long term. And that is why Evolution actually sold off today. There wasn't anything underlying wrong with the business model itself. It's just the proactive steps they're taking. And those proactive steps resulted in certain countries, certain markets in Europe not actually getting their live video feed. They cut it off, which means they're not collecting that revenue. And when they're not collecting that revenue and they still have these fixed expenses from staffing costs, depreciation, amortization, that is going to result in what we're seeing right now. And the stock is going to sell off. There was some positive highlights though. The games round index, this is sort of just an aggregate measure for what Evolution uses for activity in the network. I don't know how they calculate it. I don't know what it measures exactly, but what we can see is that we hit 376, which is the high we saw here in the second quarter. And we also did see sequential growth in activity in the network. So that is a good sign, all things considered. So in other words, we are seeing increased volume on a sequential basis as well as a quarter over quarter basis. This actually represented 10% growth, 10.9% to be exactly, on a year over year basis. So that is a good thing. Activity in the network continues to pick up. And if that is the case, you know, all of the revenue, net income and growth will come as a result. Looking at the geography makeup, revenue in regulated markets, this increased from 41% to 45% from the fourth to the first quarter 2025. We saw a jump to $234 million in regulated market revenue, and that actually represents growth of 19.4% year over year. When we actually look at North America growth, we actually did see it accelerate compared to the same quarter last year, 8.8% versus 15.3% growth. And we also saw a sequential increase in revenues for the North American segment. Latin America was a little bit soft. Q1 normally is soft. They did say they were having some regulation issues in Brazil. Nonetheless, still looking at 9.7% growth, but growth tends to be very choppy in the Latin America segment. And then we also had this segment right here, other. It grew 20% on a year-over-year basis, and it actually also grew sequentially on a nominal basis. And the net revenues was $520 million for each geography. So very, very interesting to actually see that regulated market revenue is increasing, regulated market share is also increasing, and ultimately, guys, further this number increases, right, the market will ascribe a higher multiple to Evolution just because of the safety that having a higher regulated market share ensues. Look at something like Playtech, right? They only service regulated markets and they trade on a significantly higher multiple. Something else that was really, really positive when you go to the cash flow statement and you look at accounts receivable increased significantly. This was a big problem I had with the cash flow statement in the past. You could see that throughout 2024, the company actually extended credit to its customers. It did so in the same time period last year. That is all but resolved, as you can see right here. Accounts receivable sitting at 18 million. And this really did help free cash flow, because you can see a cash flow from operating activities increased 19.9% because of what happened with accounts receivable. And then if you just subtract the acquisition of tangible assets right here, you're going to get 361 million in free cash flow, which is 27% growth. So free cash flow actually grew. This was the highest free cash flow ever for Evolution Gaming. There's also some very other good stuff that I really did like about this. The board reaffirmed a $2.80 per share dividend for the stock, and the company officially bought 4.6% of its shares back over the trailing 12 months. So that is very, very good. And if the stock's going to trade down 20%, you want the company to absolutely ramp up the buybacks and buy as many shares, discounted valuation, relatively speaking. This is very, very good news, all things considered. So looking ahead, there's a couple of things you want to watch for Evolution. Number one, you want to watch Asia growth and EU growth, okay? Because these two segments are really letting the company down. If we go back to this chart right here, you can see that Asia only grew 2% on a quarter-over-quarter basis, and Europe actually fell 0.7%. These two are the two biggest segments. So if they slow down, the overall revenue mix is going to slow down. So you want to watch Asia growth and EU growth and how ring fencing evolves. If that evolves positively, this should bode very, very well for regulation. So these are the things I would watch into the next quarter, particularly Asia growth, EU growth, and the ring fencing situation. Now, what's actually happening with the moat of the company? I think it's still a wide moat, but potentially narrowing with everything we're seeing right now. I still think the company has an extremely wide moat and I like the business, but it could be narrowing. That's my take right now. And the thesis for Evolution is still intact, regardless of everything we saw. In fact, look, what the company is doing with the ring fencing in the very long term may actually strengthen the company, but we need to see it play out. Where does it leave us with valuation? The company trades at dirt cheap valuations, a 9 times EV to EBITDA over the next 12 months, a 13 times price to earnings, a shareholder yield of up to 10% at its highs, 8.32% currently. And if you plug in the current financials of the company, $2 billion in revenue, a 58% free cash flow margin, and you see revenue growing, you can see I did adjust for the growth rate this year that we are expecting of 7%. And then you see $3.3 billion in 2029 of revenue, $1.7 billion of free cash flow on a 53% free cash flow margin. Just for the record, this quarter, free cash flow margins was 69%. Don't forget that, guys. So we could actually see upside to this figure right here. And then using a 13 EV to free cash flow multiple, we get the enterprise value, subtract the net debt, which is actually closer to about 800 million now. You get the equity value, divide by shares outstanding. I'm assuming shares outstanding decrease by 2% every single year. And by 2029, we have 185 million shares outstanding. That should give us a stock price in 2029 of $127 at a 4.4% dividend yield. And you're looking at a very, very conservative estimate of 16% compounded annual growth rate for Evolution. So is Evolution a buy right now? I think so. Yes, I own the stock. I probably will buy more once the dust settles. I do have a rule though that generally after earnings, I don't buy up to 3 days just to let the dust settle. Let me digest all of the earnings for the name, especially if things happen like with Evolution, if the stock sells off. However, I still think the moat is wide, thesis is intact, the returns over the next 5 years look great, and so I still believe Evolution is a buy right now. However, there are certainly things and risks we do need to be aware of. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.